Hello, everyone. Thanks again for taking a few minutes out of your day to join us. This is Ryan Hansen with Insurance Designs of America. I'm really excited to have Dorota Miller and Karen Hoffman from Prudential as our presenters today, and they're going to be giving us an update on the 2017 tax cut and the opportunities it presents for life insurance planning. Before I turn it over to our Prudential friends, one quick housekeeping note. Attendee phone lines are going to remain muted throughout today's call to minimize distractions. If you have a question, please type it into the chat box, and our host will answer it at the end of today's presentation. With that said, it's my pleasure to turn it over to Dorota Miller with Prudential.
Thank you so much, Ryan, and thank you to all of you for joining us today. We're going to promise to keep this short and sweet. The whole presentation and Q&A will be around 30 minutes today. And my name is Dorota Miller. Like Ryan said, I'm part of the marketing team at Prudential. We work very closely with IDA, and Ryan, he's such a great partner of ours, and that's why we're able to host these webinars, because of this partnership. And so we so appreciate you, Ryan, and IDA. And this is actually our second webinar of a three-part series called The Big Case Hunter. We're looking to help you uncover some business opportunities here, sales ideas and business opportunities within your practice. And so today I'm excited to present to you Karen Hoffman. She's a vice president in our advanced markets group. She's been in the industry for over 32 years. She speaks all over the nation to both clients and financial service professionals around all various financial topics, advanced markets and special niches there, and all types of variety of retirement planning. Karen was actually born and educated in London. I think that's my favorite thing about Karen is her awesome accent. I could listen to it all day. And with that, I will turn it over to you, Karen.
Thank you. Thank you very much. Excuse my voice. It doesn't sound as good today. It's a little bit, I'm in Southern California, so we had a lot of winds, and so the allergies have kicked in. But again, thank you, Ryan. Thank you, IDA, for letting us be part of this webinar series. I am going to keep it as short as I can, but I have a lot of material to cover, a lot of good opportunities with this tax change and the Tax Cuts and Jobs Act. So we're going to really address some of the recent tax legislation. I'm probably not going to spend too much time on some of it. I really want to focus on the biggest opportunities that we see in the advanced markets group when it comes to business planning. So probably skip a lot of the personal stuff, but really get into the business planning, because that's where we've started seeing some pretty nice cases coming in. And I think next year, going forward in the next probably 8 years until the tax changes go back, we're going to see a lot of really nice life insurance opportunities with this Tax Act. So I'm going to scroll through the slides. Just a quick note, if anybody wants copies of these slides, I believe Ryan has them, so contact Ryan and he can get these to you. So we're going to talk about individuals a little bit. We're going to talk mainly about businesses, and then we're going to really get into what are the planning opportunities that we have that we could start talking to our clients and prospects about. And if we don't start talking to them about it, if we don't bring it up in the conversations that we're having with these clients, we're going to be missing a lot of really great life insurance opportunities. So we'll cover the tax environment for individuals and estates a little bit. We'll get deep into the tax environment for businesses, and then we're going to go through all the different planning opportunities that we see and stuff that we've started already working on in this landscape. Okay, so I'm not going to go through each and every slide. You can see, and you all know, and we've heard much about it, the individual income tax rates have changed. It's going to be great for some people. It's going to be not so great for others. But as you can see from the chart, overall, it's going to affect almost every tax bracket, right? Almost every tax bracket is going to have some kind of change in the tax that they're going to be paying in the next 8 years. Bearing in mind, this all sunsets after 2025. So when you're talking to clients about planning, when talking to clients about taxes going forward, I would always bring up the fact that, hey, we don't know if this is going to last. We don't know what it's going to be in the future, but let's do the planning now. Let's take advantage of this now while we can. Obviously, capital gains, dividends have not changed. I'm not going to spend much time there. We still have that 3.8% net investment income tax, which is what we call the Medicare surcharge. That's not going to go away. So for a lot of our higher income earners, they're going to have that extra 3.8% on their investment income. Standard deductions are going to change. This is huge for a lot of people. This is going to be big in terms of married filing jointly. 24,000 standard deduction is pretty big, and as you can see from the slide, that child tax credit actually has gone up for a lot of people with kids, so that's going to be great too. But again, it's all going to sunset in 2025. So what it's going to be, what it's going to go back to in 8 years, we have no idea. But let's take advantage of the extra income that we have. If we do have extra income due to the tax rates going down, what can we do with it? How can we put it to best use now while we have it? Okay. Mortgage interest. Yep, we know that. I think everybody is aware of how much mortgage interest we can deduct. Home equity lines of credit or home equity HELOCs are no longer deductible, and there has been some changes in the charitable giving deduction, gone up a little bit from 50% up to 60% of AGI. Excuse me. Biggest change for some of us, especially those who live in these high income tax states, is the limited ability to deduct state and local income taxes and property taxes. We're limited to $10,000, which is going to hurt me and hurt a lot of people that live in this state. A couple of other things, miscellaneous itemized deductions are gone for now, and medical expenses are going to change a little bit for those who deduct those. Okay. We're going to get into estate taxes in a little bit here. I've got a lot of slides to show how it's going to look for our higher net worth clients. But for now, for those clients that don't have an estate worth over, say, 11 million, 22 for a couple, it's not going to be, a lot of changes for them. There's not going to be a lot of planning being done. However, I'm going to emphasize this every time. This is going to go away. So if you have clients that are in, the 10, I would say 10 and up estate net worth range, they still should be doing planning for the future. As we don't know what it's going to be in the future, it could go back to the 5 million per person. It could stay at the 11 million per person. We don't know that. But I would plan for it to go back down because, we have a big deficit in this country, and knowing, they need tax revenue, this could change. So that's one thing. I would still be having a conversation with every client that has a net worth over 5 million or 10 million for a couple. The other thing is I would emphasize is we don't know what it's going to be in the future. And the other thing is, would you be insurable in the future? So why do you want why would you want clients to wait to see what it's going to be in the future, and then suddenly it does go down to the 5 million per person, and now they're uninsurable. So planning now is not going to hurt those clients over and above 10 million. All right, so let's get into what I want to talk about is businesses. This is where we see and we believe the opportunities are just abundant. Okay, so the first slide you can see here is the corporate tax rate for C corporations is now permanently gone down from 35% to 21%. So what does that mean for our C Corp clients' businesses? Well, they're going to have more money. Okay, there's going to be more money available. They're going to have to spend more money because of the retained earnings. Tax, if you keep too much money in the business, you're taxed on what they call retained earnings. So we're going to see a lot more money being spent by those corporations, whether it be in salaries, whether it be in bonuses, whether it be buy more equipment, paying more wages. There's going to be a lot of money going to have to be spent. The other type of business is what we call the pass-throughs. So the pass-throughs are your S-Corps, your LLCs, your partnerships. They also have a tax break, which we call the 20% tax deduction under 199A. This essentially takes the top pass-through tax rate down from about 39.6% down to about 29.6%. So it's really not going to be as beneficial as a C Corp, but it's still going to drop their taxes down. I want to spend a little bit of time here on how that deduction is calculated. It's quite confusing, and I don't think you should get into it. I would let your clients, accountants, and CPAs do it. But what I want to say here is the pass-through entities have been broken down into two types: service corporations or entities and non-service, okay? Service are a little limited on whether or not they can take that 20% deduction. So let me just tell you what service industries include. They include the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, investment management, trading or dealing in securities. It also includes any trade or business in which the principal asset of the trade or business is the reputation or skill of one of the owners. It does not include architects or engineers. So here's what I want to say here for these pass-through entities. For those service entities, there is a phase-out over and above $415,000 of joint income, which means once they hit that $415,000 of joint personal income, there is no 20% tax deduction for those service industries. So now we may see some of those service industries going to corporate, C Corp, maybe, but what we're going to see is a lot of those service industries are going to look for ways to lower their income taxes. That might mean putting in qualified plans. That might mean defined benefit plans. That might mean anything where they can reduce their income down. So that's the service industries. On the flip side, the non-service industries, their 20% deduction is also based on a couple of tests. And one of the tests includes W-2 wages. The more wages they have, the bigger the potential deduction for them. So on the non-service side of the house, those other types of business, they're going to be looking at ways to increase their wages. That might include more executive type bonus plans and those kinds of things, those things that are reported on W-2s as wages or compensation. So on both sides of the house, we have great opportunities to help some of our clients lower their income. And on the other side of the house, we have opportunities to help our clients increase their compensation per se. And executive planning is one of the things that we're going to see a lot more. We've already had cases coming in where executive planning is something they are looking to do pretty soon here as they're going to be filing their taxes for 2018. So here's a quick quick case study on how to do a calculation. But again, don't get hung up on the calculations. Let the accountants do it. But this is just one way of showing you. Jane Smith, she's a 50% owner of a trucking company. It's an LLC. It's taxes pass through. Their total wages to their employees, not their wages, to their employees, excuse me, is $2.5 million. They have unadjusted basis in their tangible property of $1 million. And the qualified business income, that's what we're looking at, the QBI, that's distributed to Jane, according to her CPA, is about $350,000. So what would be her pass-through deduction? So what we do is we look at the total share of Jane's wages, which is half of the $2.5 million, which is $1.25 million. We look at Jane's share of the unadjusted basis in the company assets of $500,000. And then we do the other calculation. We do two calculations, and we come up with the lesser of the two. And in this case, the lesser of the two was 20% of her qualified business income, or $70,000. So her deduction, assuming these facts, would be $70,000 from her qualified business income. So, in other words, we've got $70,000, or a deduction that she gets. She's going to have more income, right? What is she going to do with this income? How can we help her plan for her future with this additional income or these tax savings that she now has? So this is really where the opportunities, I believe, with businesses and pass-through businesses is really going to help us. So let's get more into the life insurance opportunities. So we are looking at tax savings and leverage using life insurance, right? We want to sell more life insurance, and we want to help our clients save for the future and obviously protect their families and themselves with life insurance. So ultimately, the lower tax rates mean more clients are going to have more money to allocate to life insurance if perhaps they didn't before, right? But under current tax law and the tax rates that we currently have, they're bound to go up in 2025. So what does that mean? It means if we're planning on taxes going up in 8 years, why not use tax-efficient planning vehicles or life insurance that ultimately can provide income in retirement that's tax-free? Let's plan for that. Let's leverage that for the fact that we think the taxes are going to go up in 2025. The other thing about using life insurance is there's going to be a huge emphasis, and we're already started seeing it. We're already putting materials together for it. Replacing income for survivors is going to be even more important in the future. What do I mean by that? Well, if taxes go up, that's one thing. But think about Social Security and think about pensions and think about all those things that can affect a retiree or a couple in retirement. One is a Social Security check is going to go away when somebody passes away. Sometimes they haven't planned well with their pensions, and there may be a loss of income there. The other thing, there's going to be a loss of a tax deduction when one spouse passes away. So a lot of planning needs to be done to make sure the surviving spouse continues to maintain that same lifestyle in retirement when one of the spouses passes away. So there's a big emphasis on that. The other emphasis is planning for chronic care, right? We know that one of a couple, most likely in retirement, the odds are very high that they will need chronic care. And so we have those permanent cash value life insurance products now that offer those chronic care riders. And again, we're going to see more emphasis going forward on that type of planning and using those types of vehicles. LIRP. I know a lot of you know what LIRP is. I know LIRP is something you've probably done a lot of over the years. We're going to see a lot more opportunities in LIRP planning. Again, back to the last slide, looking at ways to potentially get tax-free income in retirement is huge. Tax-deferred accumulation, hedge against premature death, hedge against increase in taxes, all exempt from the 3.8% Medicare surtax, and the ability to use the cash value pre-59.5, not having to take RMDs at 70.5 without any penalties is really big. So we are seeing a lot of this business, and we're going to see a lot more of this type of planning going forward. Who are we looking at when it comes to LIRP? I'm going through the slides, and you'll notice those two numbers, 189,000 for married and 120 for single. Under 55, maximizing contributions to their retirement plans at work or whatever, an additional monthly income. They have the money, they have the extra money to put this together. Why did we use the 189? We used the 189 because that's the limit, or that's the cutoff where our clients can't do a Roth IRA, right? And even if they could do a Roth IRA, they're limited to how much they can put into the Roth IRA. So we are looking at LIRP as an alternative to doing a Roth IRA because they can't do a Roth IRA. And as I said on the slide, they've maxed out their other retirement plans. They've maxed out their 401k. They probably can't do a deductible IRA. They can do a non-deductible IRA, but again, it's limited. This is the other choice for these types of clients who have the money, they can afford to put more money away for retirement, and they like the fact that it's very, very, very tax efficient, and they have a death benefit in addition to it, which they don't get with a Roth. They have a death benefit that's self-completing if they don't make it to retirement or at a later date they pass away. And the other thing is tax diversification. LIRPs are a tax play. LIRPs are showing our clients other ways to take income in retirement that's tax efficient and that's most likely not or never going to be taxable. I'm going to switch to this slide. So how we do this, and again, you might be aware of it, but how we do this is the opposite to how we design most life insurance policies, right? Most of the time, we're looking at the highest death benefit, excuse me, for the lower premium. And when we design it like that, you know, the cash value typically doesn't grow as much or as fast because of the high fees attributable to the death benefit, right? What we do in this particular design, we build it backwards. We actually keep the death benefit as low as we possibly can without mecking it out, obviously, which keeps the fees down and allows the cash value to really, really, really grow. And as you can see on this slide, designed with less death benefit, at some point in time, as that death benefit and that cash value sort of come together, there's what's known as a corridor. There has to be a corridor between the two. As you can see, suddenly the death benefit just soars all the way up, right? Because it has to, because of the cash. So when you design it this way, I mean, this is a very, very, very efficient way to plan for retirement, to make the most out of your dollars, to get the most out of it. As you can see in this case example, I'm using a VUL. This particular client committed to $20,000 annual premium, which isn't a lot. These are the average cases that we see coming in. Between the ages of 45 and 65, put in about $400,000 of annual premium, right, after tax. And as you can see, we started out with a $400,000 death benefit, and we ended up at a little over $1 million by the time he got to 65. And then he starts pulling money out during retirement for a period of years. And again, we did this for 20 years. We don't want to continue to do it. We don't want the policy to lapse. But he pulled out and supplemented his retirement with $52,000 worth of tax-free income, which, if it was taxable, would probably be more like 70-something, right? So he pulls the money out, and at the end of the day, there's still a death benefit available to his or her spouse in case they pass away at, whatever year it is. So depending on when they pass away, there's going to be some kind of residual death benefit. In addition to this, we could have put a chronic care rider on there. So this is also available to them in the event that he needs it for chronic care or she needs it for chronic care. So it's a win-win situation for our clients in every way you look at it. Now, the only difference here is now we've got fees, right? We've got fees that you wouldn't have with an investment. But this is how I position this. And I really want to I know I'm kind of getting to the end of my time, but look at it from this point of view. If your client put $400,000 into a mutual fund, right, or whatever, some other kind of investment, and it grew and they pulled out a little over $1 million, that would be about $800,000 of gain, right? And based on, let's just call it capital gains rates, let's just say it wasn't ordinary income, $800,000 of gain at, say, conservatively 20%, right? Your client would be paying about $160,000, if not more, and that was conservative, in taxes. So we have saved the client a huge amount of money in taxes, yet given them the life insurance protection all the way through. They would have had to have paid taxes on any other investment except for, say, a muni bond, right? We wouldn't want to put everything into a muni bond. They might have some. But this really is how you position this. You have saved money in taxes. Yes, there are fees. Yes, there's life insurance. But compare the taxes to the fees, and your client will say, this looks like a good deal to me. Most likely they do when it's positioned that way. I'm not going to go over every single example, but if you look on the side of the slide where we have the internal rate of return, those internal rate of returns on the net cash value and the death benefit are pretty good. Okay, I don't want to spend too much time there, but they are pretty high. Obviously, I've got to show you a zero. We have to. I'm not going to go through this slide again, but it just shows you, again, the internal rate of returns at age 84, and the money going in and the money coming out and the net death benefit at age 84. Here's another example, little higher rate of return, little higher income. Again, look at it on the fact that they're not going to pay the taxes on that income coming out they would in any other type of investment. All right, just quickly go through these because we don't need to go through this again and again and again. Okay, so let's look at legacy planning and estate planning opportunities. We still have those opportunities, right? We still have estate settlement costs. We still have clients that want to leave legacies. We still have clients that live in states that have a state estate tax. Let's not forget about those. And a lot of times clients do want to take care of special needs children or children that aren't very good with money. So estate planning isn't dead. The need for estate planning is still there, and the need for life insurance, leveraging life insurance for estate planning and legacy opportunities is still there. As I said earlier, providing for surviving spouses is really going to be a huge thing going forward now as those surviving spouses live longer. Quick couple of examples. Don't want to spend too much time here, but this is just going to show you a high net worth client has currently $20 million current net worth, and we're going to show you if the estate tax sunsets, if the estate tax doesn't sunset, and then using a trust instead of using just investments. We're going to assume their estate grows at 5% overall, and their age is 58. Both of them are age 58. So as you can see on the left-hand side of the screen, we're assuming that the tax law or the estate tax exemption goes back down, right? So in this situation, for this particular client, their estate taxes will be about $33 million, and their wealth to heirs would be $66 million. So that's going back down to what it was before, $5 million apiece. On the other side of the screen, we're going to have no sunset, where it's going to stay as it is currently. And as you can see, wealth to heirs is going to be $73 million, and their estate tax is going to be $26. So it's going to be less in estate taxes for sure. All right, that's obvious. So now we're going to take that same right side, left side, and on the left side, we're going to put $5 million. We're going to give $5 million to a trust. That trust is going to grow. Is going to earn a 5% rate of return. But on this side of it, we've still got estate taxes of $18 million, so a little lower. We've got $75 million going to the heirs, which is a little more than the other side of the screen. But now we've got $25 million in that trust also going to the heirs, right? So that's obviously a better way to do it. More money is going to the heirs and less money is going to estate taxes. Now, on the right side of the screen, the left side is what I just went over. The right side of the screen, we're going to do the same $5 million gift to an ILET like we did before, but this time we're going to send that money, that $5 million, that whole $5 million, to a life insurance policy, a second to die, with a $30 million face amount. So now you can see wealth to heirs, $75 million. Nothing's changed from the other pie chart. Taxes, not much different there, a little bit in estate taxes. But now we've got an additional $30 million inside the trust, tax-free, estate tax-free, going to the heirs. So again, the planning is still necessary for these high net worth clients, whether or not the law sunsets. Okay, doesn't even matter. It's still going to make a difference of a few $1 million here and there, depending on how we do it. So let's talk about businesses. Corporate tax cuts are permanent, so corporations, and I said this earlier, are going to be more liquid. This opens the door for more life insurance funded by sell agreements, especially entity purchase. Now the corporate AMT has been repealed permanently. We're going to see a lot more of those. In fact, you should be reviewing current corporate buy-sell agreements to see if it would make more sense to do an entity versus a cross-purchase. We're going to see more non-qualified executive benefits, as I said before. We're going to see more split dollar. We're definitely in C corporations going to see more deferred compensation, SERPs. We're going to see, hopefully, a lot more key person coverage. Now corporations have more money and are more liquid, and they can provide more benefits to their key employees and their executives. So I'm at my 30 minutes. I'm going to pull this together and then open it up for questions, or Ryan's going to open it up for questions. So this does impact individuals and businesses. There are a lot more planning opportunities. This has given us wonderful opportunities to talk to people, especially when it comes to taxes. People always want to talk about taxes. They always want to talk about saving money in taxes, and tax planning is really the key to all of this. So it gives us more opportunities to review and plan. Your clients are going to have questions, right? So understand how this all works. Now's the time to contact them, because we're coming up to the end of the year. Taxes are going to start being done. I'm not looking forward to it, but I'm hoping when I start doing my taxes in January that it's going to look good for me, and I think a lot of people are going to feel that way. We need to work with our clients, other advisors, their CPAs, their attorneys, because there's going to be so many questions being asked and so many more planning strategies are going to be looked at. If you need any help, we are here. The advanced markets team at Prudential is actually one of the biggest in the industry. We have a very large group of about 15 of us. We have a lot of pieces. I believe I sent one piece over to Ryan. I think you have a marketing piece. We have some other marketing pieces on our website. If you have questions or you need help, we are here. I'm going to give you the number for our advanced markets team. It is 800-800-2738, option 4. I'll give it to you again, 800-800-2738, option 4. Leave a message. Somebody will call you back right away. It actually sends everybody an email that there's a message in our voicemail, and somebody will pick up the phone and call you right back. So I talked really fast, Ryan. I'm a good fast talker. Hopefully, I covered everything. Actually, Doretta, are you? Am I turn it over to you and then to Ryan?
No, I think we can go ahead and turn it over to Ryan to open it up for questions if we do have any.
That was great information, Karen. Really appreciate that. That was chock full of very useful information. For our audience here, if you have any questions, and now would be an excellent time for you to type them into the chat box on the right-hand side of your screen, and we'll read those to our presenters, and they'll do their very best to answer them. I'll get things kicked off here with one question, Karen, and admittedly going to ask you to editorialize on something, so I know that's a little dangerous at times, but I've heard both schools of thought when it comes to the sunset of the 2025 of the the personal tax cuts. One is that it's simply politically unpalatable for whoever's in whatever party's in power at that time to let those tax cuts expire. But then conversely, you look at the deficit projections and everything like that, and assuming we haven't experienced some sort of really robust growth between now and then, there will be a pretty significant shortfall that will need to be made up. What's your personal opinion on what 2026 and beyond will look like for that the personal side of the tax breaks?
I sort of kind of agree with it's going to be politically very difficult for another party or whoever to come in and just raise the rates, right? Or even campaign on the fact that they're going to change it. I think it might be suicide for them politically. I think the estate income taxes maybe not, but I do think estate taxes. For some reason I just can't see them staying at that level. That the estate tax exemptions, I just can't see that. So if I were to bet, personal tax rates probably won't go up too much, but I really think the estate tax exemption will come down. That's my thought.
Very good. We appreciate it. Much more informed speculation than what I, or I'm sure anyone else on the phone call could likely provide. Have another question here for you. Do you have any concerns about combining LERP plans and LTC/CI riders into the same policy?
I don't. I mean, some firms that we work with won't allow it. I personally, if I was going to do a LERP, I would put it on. Especially if it's a client in their early 40s, 50s, it's not really going to impact the cash value too much, and it's really not going to affect the premium. So I would do it that way. I just think you're covering all bases, and it's not going to hurt. It's only going to make it better.
Excellent. Well, no further audience questions for you, Karen. We really appreciate the excellent information. If anyone does think of a question, Karen, you want to share that phone number one more time?
Yep. 800-800-2738, option 4.
All right. Dorota, any closing thoughts?
No, I just wanted to thank you again. Thank you, Karen. Thank you, Ryan, all of IDA, and everybody who joined us today. And I'll just put in my 30-second commercial that next week is our third and last webinar. That's on 10/23, same time, 11 a.m. Central, and that's going to be the trifecta of sales ideas for Index Advantage UL. So again, thank you all, and have a wonderful day.
Thank you.
Great. Thanks, everyone. And just one quick plug, if if you missed last week's webinar, be sure to ask your insurance designers agency. They have a copy of the replay. And last week and this week and next week's webinar are all geared around just giving you sales ideas to help you close out the year strong. So we appreciate you joining us. Take care.
Thank you.